Welcome back to Investing Talk Podcast.
Today, we are opening the vault on a company that has become the absolute battleground for precious metals investors. We are talking about First Majestic Silver.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out with the algorithm. Now, First Majestic. I feel like this ticker AG is always in the trending tab. But looking at the research we've pulled, this isn't just a story about digging rocks out of the ground, is it?
No, it's much more than that. First Majestic has positioned itself as the high beta proxy for the silver market itself.
Okay, pause right there. High beta. We promise to keep this accessible. For you listening on your commute right now, what does that actually mean for your portfolio?
Think of beta as a volatility multiplier. So if silver prices move up by 1%, a high beta stock like First Majestic might move up by, say, 2% or even 3%. It just amplifies the move. It's the vehicle everyone looks at if they're bullish on silver and want maximum exposure without, buying futures.
And the performance proves that, I guess.
Oh, absolutely. The performance backs that up. The stock is up over 200% year over year. It is significantly outpacing the metal itself.
That chart looks incredible, I'll give you that. I mean, it looks like a rocket ship. But here is where I have to play the skeptic immediately. We're recording this in the wake of some serious volatility. Just a couple of weeks ago, January 8th, 2026, we saw a massive flash crash in silver prices.
A huge one.
We're talking about a drop of 10,000 rupees in a single day in the Indian markets, and global prices taking a massive hit. And HSBC is out there explicitly warning that these price levels are unsustainable. So the big question we need to answer today is this the peak? Are you buying the top of a bubble, or is this just a shakeout before the real move?
It's the multi-billion-dollar question. And to answer it, we have to look past the daily price ticker, which is noisy, and look at what is actually happening inside the company's operations. Because 2025 wasn't just a good year. It was a record-breaking year for First Majestic by almost every metric that matters.
All right, let's pivot to the fundamentals then. You mentioned records. Give me the hard numbers. What made 2025 so special?
It is the revenue inflection that really stands out in the reports. If you look at Q3 2025, revenue hit $285.1 million. That is a massive 95% increase year over year. I mean, we are essentially seeing a company that has doubled its top-line generation in just 12 months.
Doubling revenue is impressive, but I need to know the why. Is that just because silver prices are expensive right now, or are they actually getting better at pulling more metal out of the ground?
It's a combination, but the production numbers are genuinely staggering. Full year 2025 silver production hit a record 15.4 million ounces. That is up 84% from 2024.
Yeah.
And here's the key insight. This isn't just organic growth from, squeezing old mines. This is driven by the successful integration of the Los Gatos acquisition and the expansion at Santa Elena. They bought growth, and unlike many miners who struggle to integrate new assets, they executed on it perfectly.
Okay, I have to jump in here with the skeptic check. The revenue number is great, 285 million, huge growth. But when I look at the bottom line, the story gets a little murkier. Despite that record revenue, they missed earnings expectations in Q3. Wall Street expected 11 cents per share. They reported 7 cents. Why the disconnect? If they are selling so much silver, where is the profit?
That is the friction point. They did miss on EPS or earnings per share.
And that worries me because of the cost realities. We're seeing their AISC, that's all-in sustaining costs, projected between $26.15 and $27.91 per silver equivalent ounce. For you listening, AISC is basically the break-even price to keep the mine running and replacing the ore you took out. $27 is high. Historically, that is very high.
It is high. It reflects the inflationary environment miners are operating in.
So if silver prices do crash, if HSBC is right and we go back to the 50s or 40s, those margins are going to compress extremely fast. If silver drops to $27, they make zero profit on every ounce they pull up. They need high silver prices to justify those costs. It feels like they are walking a tightrope.
That is a fair concern regarding the unit costs. Inflation hits miners, hard fuel, labor, steel, it all adds up. But you have to look at the financial health of the company to see if they can weather a storm. And I would argue their balance sheet is, well, it's fortress-like right now. Their debt-to-equity ratio is incredibly low at 0.07. They basically have no leverage risk.
0.07 is practically zero debt in this industry. Usually miners are loaded with debt to pay for all that heavy equipment.
Exactly. And their liquidity is robust. The current ratio is 3.38, meaning they have more than 3 times the current assets cash, inventory to cover their short-term liabilities.
Mhm.
They have a cash on hand to fund this massive capital expenditure plan for 2026. We're talking $213 to $236 million to expand Santa Elena and Los Gatos.
And they can do that without issuing new shares.
They could do it without diluting shareholders. They don't need to go to the market with a tin cup asking for more money.
That is a crucial point. Usually when a miner wants to expand, shareholders get diluted, meaning your slice of the pie gets smaller. If they can fund this internally, that's a big win.
Right. And instead of dilution, they're actually increasing returns. They just bump the dividend to 2% of net quarterly revenues. That signals management confidence. But the real fundamental argument here, the reason they trade at a premium, is the moat.
The famous moat. It's hard to have a moat in a commodity business where everyone sells the exact same product. Silver is silver. What is their advantage?
It's the purity of the asset.
Yeah.
First Majestic is a pure play. Most of their competitors are actually gold miners that dig up some silver, by accident as a byproduct. First Majestic gets over 50% of its revenue directly from silver.
Ah.
That gives them unique leverage. When silver moves, First Majestic moves harder. That scarcity value, being one of the few places a fund manager can go to buy silver exposure, that is the moat.
Okay, that explains the fundamental setup. High costs, but high growth, clean balance sheet, and that scarcity premium. Let's pivot to the technicals, because the chart tells a very dramatic story.
It certainly does. If you pull up the one-year chart, the stock is up about 217%. It has been an absolute runner. We're seeing it hit 52-week highs, trading in that $17.92 to $23.3 range, depending on the volatility of the day.
And for the technical analysts out there, it's trading well above the moving averages, right?
Consistently. It's well above the 50-day and 200-day moving averages. In technical terms, we're in a clear golden cross regime. That's when the short-term trend, the 50-day, crosses above the long-term trend, the 200-day. It's often a signal that algorithms look for off to start buying automatically. The trend is undeniably up.
The trend is up, but the ride is nauseating. I was looking at the volatility data. This stock has a habit of dropping 4 or 5% instantly on any bad news. When that earnings miss hit, down 4%. When silver had that flash crash on January 8th, boom, another drop. It isn't a stock you can just buy and forget about.
No, it's definitely a high volatility name. You have to have a stomach for it.
And looking at the momentum indicators, the stochastic RSI is hovering in the low 80s. For those listening who don't stare at charts all day, that usually indicates a stock is overbought in the short term. It's running hot. It might be due for a cool-off or a consolidation. It's like a sprinter who has been running at full speed for too long. Eventually, they need to catch their breath.
It is extended, sure. But remember, in a strong bull market, assets can stay overbought for a long time. Just because it's high doesn't mean it has to crash immediately. Momentum is a powerful force.
True, but here is the one that caught my eye, option flow. We're seeing unusually high call option volume, about 91,000 calls, which is 40% above the average. Everyone is betting on this thing going up. Speculators are piling in.
Which you see as a warning sign.
Sometimes when the book gets too crowded on one side, it tips over. It can be a contrarian signal. When everyone is euphoric and buying calls, that's usually when the smart money starts selling into that strength to lock in profits. It suggests the market is getting a bit frothy.
Speaking of smart money, let's shift gears to sentiment. Who is actually holding the bag here? Are the big institutions staying put, or are they selling to these retail speculators?
Right, let's look at the institutional players.
Well, according to the data, the smart money is actually buying. Institutional ownership is around 27%, which leaves plenty of room for growth. It's not overcrowded yet compared to some tech stocks. But the quality of the holders is interesting. Major funds like VanEck and Array Asset have been materially increasing their stakes.
So they're not selling.
They aren't selling into this rally. They are adding to it.
That is a vote of confidence. Usually these funds have rigorous risk models. If they're adding at these prices, they see long-term upside. What about the quantitative side?
The new sentiment is overwhelmingly bullish. If we look at the AlphaVantage data, the weighted sentiment score is around 0.42. That is very positive. The headlines are all about record production, triple-digit growth, and dividend hikes. The media love affair with this stock is in full swing.
It is. But analysts, the humans writing the reports, are a bit more cautious, aren't they? The consensus rating is generally a moderate buy, but look at the price targets. The average target is around $17.26 or $17.33.
And the stock is trading above that.
Exactly. It's trading above what the analysts think it's worth. That usually implies limited upside unless those analysts rush to upgrade their targets. And there's one other little red flag I found in the data. While the institutions like Vanek are buying, there was a mention of insider selling.
Insider selling.
Yes. It's not a massive exodus, but there is data showing insiders taking chips off the table. When the people running the company, who know more than we do, are selling while the stock is at all-time highs, it's often a signal that they think the price is, shall we say, rich.
That is a fair point. Insiders selling into strength is definitely something to watch. However, insiders sell for many reasons. Buying a house, taxes, diversification. Institutions usually only buy for one reason. They think the stock's going up. So the divergence there is interesting, but I lean toward the institutional accumulation as the stronger signal.
Fair enough, but let's talk about the macro picture, because this is where the bear case really has some teeth. We need to talk about the risks.
Go ahead. What is keeping you up at night regarding this stock?
It's the silver market itself. We mentioned the January 8th crash, but we need to unpack the HSBC warning. They aren't just saying, be careful. They are explicitly warning that silver prices have reached unsustainable levels.
Unsustainable is a strong word from a major bank.
It is. They are forecasting prices to drop to $57 in 2027 and then down to $47 by 2029. Now, remember what we said about First Majestic's costs. Their all-in sustaining costs are over $26. If silver falls back toward those levels, the profit margin we are celebrating today evaporates.
Right.
First Majestic is a high leverage play. That leverage works great on the way up, but it is brutal on the way down. If silver drops 20%, First Majestic's profit might drop 80%.
That is the classic risk with pure play miners. They are effectively leveraged ETFs on the metal. If the metal tanks, the miner tanks harder. And because they're a pure play, they don't have a gold division to cushion the blow.
And then there is the valuation. We are paying a premium for this leverage. First Majestic trades at a price-to-sales ratio of 10.9x. That is significantly higher than the industry average. You are paying a tech stock multiple for a mining company.
It is a steep multiple, no doubt.
Yeah.
Investors are paying for that purity and the growth we discussed.
In Guru Focus, their value model suggests a fair value closer to $9.07. The stock is trading at double that. If the growth narrative breaks, or if silver price is correct, the downside risk here is massive. We could see a 50% haircut just to get back to fair value.
I will concede one point on the growth narrative as well, which supports your bear case.
Yeah.
If you look closely at the 2026 guidance, production is actually guiding down.
Wait, really? After the record 2025?
Yes, they produced 15.4 million ounces in 2025. The guidance for 2026 is 13.0 to 14.4 million ounces.
So production is shrinking. Why?
It's a decrease due to geology.
Yeah.
They are dealing with lower metal grades at some of the mines. Basically, they have to process more rock just to get the same amount of silver, or in this case, slightly less. So the company needs higher throughput just to tread water. That puts even more pressure on the silver price to keep the revenue growth going. They can't rely solely on volume growth in 2026.
That is a critical detail. The rocket ship growth story might be stalling out in terms of actual ounces produced. So you have shrinking production guidance, high valuation, and a major bank predicting a silver crash. That is a tough setup for a long position.
It is a tough setup if you look at it through a bearish lens, but you have to weigh that against the potential upside of the commodity cycle. The bear case assumes silver reverts to the mean. The bull case assumes we're in a new paradigm.
Okay, let's get to the bottom line then. We've looked at the record revenue, the high costs, the insider selling, and the bullish institutions. What is the verdict? How are we scoring this?
I've looked at everything, and despite the valuation concerns, I am giving this a bullish score of 8 out of 10.
An 8? That's pretty high given the risks we just discussed. Justify that.
It comes down to positioning. First Majestic is simply the best vehicle for a silver supercycle. If you believe, as UBS does, that we are in a broad commodity rally, UBS is predicting gold to hit $5,000, then silver's going to follow and likely outperform. First Majestic has the operational improvements, they have the cash, and they are optimizing the portfolio.
You mean the asset sales?
Exactly. The sale of the Del Toro mine for $60 million is a great move. It gets rid of a non-core asset and brings in cash. They're focusing on their best assets.
So what is the trade here? What is the investment thesis for the listener?
The time frame is key. This is a 12 to 24-month hold. You aren't buying this for a quick flip next week. You are buying the operational turnaround and the integration of Los Gatos. The fact that they flipped earnings from negative to positive proves the strategy is working. You are betting that they can continue to optimize cost while silver stays elevated.
So you're buying the execution capability of the management.
I'm buying the execution and the leverage. If silver goes to $100, this stock goes to the moon. It's an asymmetry play.
But, and here is my final skeptic warning, this is not for the faint of heart. This is a high volatility play. We saw what happened on January 8th. If you cannot stomach a 10% drop in a week, you have no business being in this stock. It is a levered bet on a volatile commodity.
Absolutely. Position size accordingly. Don't put your rent money on this.
And I'll leave you with this thought. If the green energy transition accelerates solar panels, EVs, all of which need silver demand, might blow those bearish HSBC targets out of the water. But if the global economy slows down, industrial demand for silver drops, and that floor falls out, it's a binary bet.
It's going to be a fascinating year to watch.
It certainly will. Don't forget to subscribe to the channel for more unbiased analysis. We'll see you in the next one.